A new institutional investor survey is out from Goldman Sachs, and it's in. You should play the rate cut theme for the first half of 2024, according to institutional investors. This means interest rate sensitive names, maybe a lot of names that we have been buying for the last 2 years, might really start to outperform in the beginning of 2024. We'll talk about why that is, but most importantly, 3 stocks that will benefit from this that I think will do very well in the month of January. Let's go ahead and get started. Here is the survey. This was conducted by Goldman Sachs. They asked institutional investors, what is the most tradable theme in 2024? To my surprise, mega cap tech / AI, only 7% of institutional investors said that is the theme that you should follow. But 30% of institutional investors said rate cuts. That's interesting. Because who benefits from rate cuts? Well, generally speaking, small and mid-cap companies. Maybe the stocks that have not done well over the past 2 years are the ones that benefit the most from that tradable theme. Tom Lee with Fundstrat, one of the best analysts in the world, the only analyst that was correct about 2023's stock market prediction back in December of 2022, got it perfectly correct. He thinks small cap stocks could rally 50% in the year ahead. But he does share some valuable insight on the S&P 500 valuation statistics as well. He says, quote, I think many are citing the wrong PE valuation statistics for the S&P 500. And he says, looking into 2024, starting PEs at 15.3x, excluding FANG, is a good entry point. So if you take out big tech, if you take out FANG, well, valuations are not that stretched. Small caps, he says, are still our top call for 2024. Golden also writes on X, quote, it's different this time. Soft landing is the most probable outcome. There, I've ripped the band-aid off for you. The disinflation cycle we've seen now is the fastest and deepest from 9% to peak. And to where we are today at CPI at 3.4%, we've never seen such a decline like this. And here's another stat for you. The S&P 500 will be up 9 straight weeks. The last time that we seen this was in 89, 94, 85, and 2004. The next 12 months after you see a 8+ up week is some big gains. In 86, 14%. In 1990, you were actually down 4.5%. In 95, you were up 34%. And in 05, you were up 3%. So most of the time, you tend to have a positive forward 12-month return after going through a rally like we just went through. Now, as I've said before here on this channel, one of the main reasons I think stocks will do very well in 2024, maybe not your Magnificent 7 names, but your broader markets are going to play this catch-up, is because of all of the cash on the sidelines. The fact that we are avoiding a recession, inflation is falling, $6.2 trillion in money market funds. That's $3 trillion higher than what you've seen in 2019, almost $3 trillion higher than what you've seen in 2019. These are all very important points. And if you strip out big tech, the markets are actually pretty appropriately valued. If you look at just small caps are very undervalued compared to historical averages. Then you have this, 65% of large cap fund managers are underperforming the S&P 500 ETF. In 2023, about 75% of fund managers underperformed in 2022. That was because it was just a rough year. 2023, you don't have as much of an excuse. Just everyone thought a recession was coming, so they were underallocated to stocks. That did not happen. Big gains formed, and hedge fund managers did not, participate in that. So think about it like this. If you are a hedge fund manager, if you are letting someone else invest your money, let's say they underperform in 2022, that's fine. Everything did poorly. 2023, let's say they underperformed. Well, that's not good. 2024, you cannot afford to underperform. And unfortunately for, the shorts and the bears out there, hedge funds and institutions are going to get allocated to stocks probably here very shortly. I would imagine in the month of January, there's going to be a lot of new position taking in our markets. Now consider what happened today. I think this is very valuable to point out that today is the last trading day of 2023. So today the S&P was down about 0.5%, IWM down about 1.3%, close to 1.5%. Why is this happening? Well, this is the last day that you can actually tax loss harvest, and I think you're going to see a lot more inflows in the start of 2024. I just think a little bit of weakness here probably is a good thing rather than a bad thing. Reset some of your relative strength metrics, going from, 79 on IWM down to 67 to start off a new year. That's pretty good. The S&P 500 going from 82 down to 68. That's a good place to be to start the new year. And starting next week in January, you're not going to see any tax loss harvesting actually taking place. Now let's discuss the 3 stocks I like the most for January. We'll talk about why, but these 3 stocks, one of them is very high risk, high return. One of them is kind of medium risk, medium return. And the next one is kind of the same, right? Medium risk, medium kind of return potential. But one of them is very high reward, high risk potentially. Now, I want to say right off the bat, if this is not one of the stocks, but if you are someone that just wants to participate in the small cap rally that I think we're going to see, and you don't want to play individual stocks, you can always buy IWM. That's the ETF for the Russell 2000. Tom Lee thinks this thing could rally 50% in 2024. I believe that is pretty accurate. I think that's where IWM, is going to go to about 300. So that would be about $100 per share of this ETF if you just bought that thing for 2024. Now, obviously, the return, might not be that great, or it might lose money in 2024. I'm not a financial advisor. Who knows at the end of the day? But this is probably the safest way to play any kind of small cap momentum that we see in 2024. The first stock up, this is the one that I personally like the most just because it's, high risk, high reward for the month of January. And we do have events coming up. This is FUBO. Now, we know we're getting closer to the end of the NFL season, right? Basketball as well. There's a lot of people that are going to be tuning into sports this time of the year. So FUBO should benefit from that. Now, FUBO is less than $1 billion market cap. There is potentially huge returns if FUBO gets this thing correct. FUBO should be turning profitable at some point late 2024, if not early 2025. The sooner, the better, and I think that's going to be a big turning moment for FUBO. But you are seeing a big shift from cable to something like a FUBO. Now, FUBO focuses on sports, but they're also benefiting from the tailwind kind of effect of people cutting the cord, getting off of cable, and moving to other TV alternatives. So I think FUBO is more of a long-term trade or investment, but in the month of January, FUBO should start to perform well because it is very interest rate sensitive. It's been very under allocated to over the past 2 years. And let's be honest, FUBO, even when it IPO'd, was at a much higher price, than where it is today at $3.20 per share. During the heights of the Rona, you hit as high as $62 on FUBO. That would be, a 20x from here. Now, I'm not saying you're going back there anytime soon, but could you hit $10? Sure. Could you hit $5 in the month of January? Sure. If you were to hit $5 in the month of January, just alone for an example, let's say, there's good numbers for FUBO, there's a lot of good traffic and people are getting FUBO services, that could be a rally of about 50%. Now, that's not my base case, but that is a possibility, especially starting a new year in 2024 as capital comes back into our markets. As Tom Lee said about 6 months ago, the biggest problem that most of the markets is actually facing is a liquidity crisis. There's just not any money heading into stocks. Now that's going to change, in my opinion, in 2024. The second stock up is one that a lot of people have recently taken an interest to. I took an interest to this thing way before I should have in 2021 and 2022. I've been averaging down ever since. My average is around $93 per share, and I will show you guys the positions that I have in all of these names at the end of this video. But it's PayPal. Now, PayPal stands to benefit from a stronger consumer, avoiding a recession, and interest rates falling. That'll open up the door for PayPal to potentially become even more profitable and to explore other kind of revenues. PayPal also has Braintree, which that is going to be a much larger fueler of growth over the coming years. But I do think January could be a strong month for PayPal, and you could see, quite some inflows to PayPal, because PayPal is not a super risky name. PayPal is not going anywhere, and the valuation is trading as if it's a coin toss. The stock goes bankrupt in the next, coming 12 to 36 months, which we know that is not the case. PayPal actually fundamentally has been doing just fine over the past, 2 years or so. The stocks went from $300 down to, $61.41 at the time of recording this video. I do think there will be a lot more money go into PayPal stock in the month of January. I could see this thing hitting $70+, maybe as high as $75 in the month of January. Could be even higher than that. They do report earnings in early February. The next stock up, I think, is by far the safest out of this group, relatively speaking. It's Tesla. Now, Tesla has a couple catalysts coming. We know FSD is likely entering into the Chinese market in January. We do know that Tesla is going to give us their Q4 delivery numbers on January 2nd. Now, if those delivery numbers are good, that could set Tesla up for a multi-month rally, not just a January rally, but a multi-month rally, as Tesla stock is still down 40% from all-time highs, and I really can't think of a more interest rate sensitive name than Tesla. I mean, talk about a stock that is severely underallocated by hedge funds and institutions in the land of big tech. The only thing that has kept this thing afloat in the last, 2 years is retail investors plowing money into this thing. And I think there's a lot of people that are super negative on Tesla when, for good reason, margins have come down a lot. Tesla's cut prices a lot, but Tesla might actually raise prices in 2024. The second half of 2024 seems more likely for that than the first half, but nonetheless, I do think January could see a lot of inflows. Current market value in Tesla sits at $7,500, currently up about 6.5% on this name. FUBO currently have about $7,800 in FUBO, up almost 31%. Still think that is a fantastic place to be. PayPal, definitely the loser here, down about 34.5%, have about $7,000 allocated to this one. Also have a $60 call option for September, worth about $1,000 as well. So very confident in these three trades, as you can see from the position size. Let me know what your top 3 stocks are for the month of January down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.